obviously there's been a lot of tumult. There's been a change in narratives, but this isn't just about what happened with the carry trade. We've actually seen some regime shifting around what the market is expecting in terms of Fed policy and a programmatic set of easing that they're obviously desiring, but also a set of election outcomes that the market was positioning for. And so you've got this confluence of events. And actually, I think today isn't really telling you much because we're still kind of running up against this resistance of 528, 529 on the S&P. And if we fall short of that, I actually think the message is there's a little bit of an unwinding of the narratives.
So how much further do we have to go, especially considering how intense the run up was, right?
Right. First of all, I think equity investors have a narrative that they've been pushing. And Matt, Carol, we know that they've been pushing this narrative for well over a year. And every time they get disappointed, there's a hissy fit, there's a shock, and volatility moves. But the difference this time, I think, is that with the unwinding of the carry trade, you began to see that some of the excesses of the post-COVID, of the COVID and post-COVID period, we added to the reconciliation, to the disintermediation of fiscal, of monetary, and then of the reality that the Japanese source of liquidity may not be unimpaired, may be somewhat impaired going forward. And when you look at those things, it was too much for the market to digest at once. Obviously, the Trump, change in Trump election odds also had an impact. But I think most important is this idea that either the U.S. is going into a real recession, which does have an impact on sectors and rotation, or it's going to avoid that, and the Fed is going to ease into slightly less punitive inflation to give the market kind of this Goldilocks scenario. That is coming into question here because it's very much in the equity mind that a softening of economic activity is going to change analyst expectations. It is going to change the earnings expectations, which really to date have not really changed much if you look at the S&P and the breakdown. So there is this need for the Fed to come in and give a little support if in fact there is maybe not a big R recession, but a little slow down, little R recession.
You sound pretty calm.
But you sound skeptical. I mean, where do you think the S&P should be? I mean, take out the fluff, take out the froth, take out the story, right? And what's fair value?
Well, at Easterly EAB, we advise clients on where the asymmetry is. We like to look at what is advantage from an asset allocation point of view, because it's very hard to know, should the SPX be at 5150 or 5100, or should it be 5400? It's very difficult to know. But what we do look at is where is volatility? Where should volatility be based on the open items, right? If you look at correlations, should bonds and stocks be correlated? Now, in the last week, just to give you a sense of how silly some of these moves are, in the last week, the correlation of TLT, of 10 to 20-year bonds and equities went from being relatively positive to, in the 35, 40% range, to the 60-day correlation is now actually a negative, 0.5% or 1%. Has there really been enough clarity in the in the Fed's program to justify a 30% change in 60-day correlation within a week? I would say no.